It might be time to give up on those CDs. If you've been taking advantage of CDs or high yield savings accounts over the last few years, I don't blame you. I have too. But in this educational video, we're going to break down where the rates are looking like they're going to be going, some things to analyze, some things to know, and some ideas to keep in mind for your future money. If you're new to this channel, welcome. My name is Kyle Demian, founder of the Wealth Academy. And today we're talking about CDs and their rates. Have you ever wondered why sometimes banks are paying 5% for CDs and other times it's barely 1%? It all comes down to the Fed funds rate. So banks are businesses, right? Now, sometimes they end the day short on cash and they need to be able to borrow money quickly to keep things running smoothly. And so that's what the Fed funds rate is designed for. And instead of borrowing money from their consumers, their clients, they can borrow from each other. And the cost to do that depends on what's called the Fed funds rate. And so when the Fed's fund rate is low, they don't need money from you because it's cheap to borrow from each other, right? And if they can borrow from another bank for 1%, why would they ever pay you 5% on your CD? And that's why low rate environments create low rated CDs. Now, when the Fed's fund rate is high, it's expensive to borrow from other banks. So instead of borrowing from other banks, that's how they can offer you for 5% if the Fed funds rate is 6%. Instead of borrowing money from another bank at 6, they borrow it from you and from their clients at 4 or 5. And now that's important to understand because we're going to go ahead and I'm going to pull up a chart here. We're going to look at the Fed funds rate today and what it looks like and what it's starting to do and what some of the things on the horizon may start to be. Now, Jerome Powell has started making cuts this year. They're calling for him to maybe no longer be the chairman of the Fed. And so if that were to happen, and rates have already started coming down, um, and if you see here in October of 2025, where we sit here today, it's at just over 4%. And now the interesting thing with that is if you look at and do some research, I pulled this from a company called Wealth Tender, where they're analyzing where rates are going to go in the future. Some of the recent reports are projecting that by the end of 2025 could be at 3.4%, and 2026 2.9. Morningstar says between 3 to 2 or maybe even 2.3 in 2027 and beyond. And so if everybody is expecting interest rates to start coming down, so are those rates on your CDs. Specifically, if you ever notice when you go to get a CD right now in November of 2025, I've talked to many clients that are saying, like, yeah, the 6 month CD is actually more than what they'll pay me for a 12-month or an 18-month. And that tells you exactly what the banks are expecting the rates to do as well. You see what I mean? Like, they don't want you to lock up your money for the long term if rates are going to be lower in the next 1 to 2 years. And so they're incentivizing you to only put your money into maybe a 5 month CD rather than a 10 month. This comes exactly from Chase, who right now on $100,000 plus, you could get a 3.7% rate for 5 months or a 3.15% rate on 10 months. With Huntington, similar story. You could get a 4% rate if you did something for 5 months or 3.05 if you did it for 9 months. They don't want you locking up your money long term because they know more likely than not when your CD matures in the 5 to 9 months that rates will be lower, meaning that they can then offer you a lower rate. And so this is totally reverse from what people were experiencing even just 2 to 3 years ago, where they could lock in, some people even were able to get 5.25 on CD rates, maybe even high yield savings accounts rates within the last few years. But with everything going on in today's economy, this is no longer the trend and things have to change. So, in this day and age, right now, at the end of 2025, if you are looking for an alternative place to store your safe money outside of the banks, because banks are just going to continue lowering your interest rates, maybe consider putting your money with an insurance company. There's two different types of strategies that you can use and leverage with an insurance company through what are called annuities. Now, if you've ever heard anything about annuities in the past, there are many different versions, and I'm probably not talking about the type of annuities that you're familiar with. But simply enough, there are two different types of annuities that you can look at. There are rate lock annuities that can lock in a rate of probably north of 4%. Don't quote me to it, but you could get a 4% rate for 2, 3, or maybe even a 5-year account. And that is as of today. Rates could change. But because insurance companies don't have the Fed funds rate that they totally have to rely upon for their business every single day, like banks do, insurance companies can offer you longer terms on your money to lock in these rates with the rate lock. And then, secondly, we have a growth lock opportunity, meaning that you can put your money into an index strategy that has a market floor or a principal protection, meaning that even if the market crashes, you're not going to lose any of your money. You will get a 0% return. But if the market does well, you may be able to capture upsides of 8 to 9% of that growth up to that cap. And so this could be an opportunity for you to safely grow your money with higher upside potential than currently what the banks are offering. And so, if that might be a strategy for you that you want to explore to see if it would be a good fit for you, feel free to click the link below in the description or go to www.thewealthacademy.com and schedule a time for us to chat. If you found this video helpful, drop your comments below. Let me know what other questions you have that I should create videos on. And as always, subscribe if you guys want to learn more about retirement and ways to safely grow your money. Take care.